Hello, with me today I have Thomas McMahon, Senior Investment Trust Analyst at Kepler Trust Intelligence. Hello Thomas, thanks for joining me today.
Good morning, Lee. Good to speak to you.
Now look, 2020 has been like no other, and it's been a mixed year for the investment trust sector. Is there anything that you've learned from the past year, even as an investment professional? And also, what are the big takeaways for the investing public?
I think 2020 has reminded us of the usefulness of all the old investment advice. So we were blindsided by a totally unexpected event from outside of the economy, from outside of investment markets. And it doesn't matter how good your analysis had been prior to the event, it was suddenly made irrelevant by events. So I think this is a reminder to all of us that if we're not diversified, if we're not prepared for different outcomes in our investment portfolios, then we're really just gambling on something not happening like this. So I think that's been a useful lesson. I think it's also, for me, what was quite remarkable to watch. So I didn't see the 2007, 2008 crisis, but it was probably the same then. That you saw almost indiscriminately the investment trust sector saw its share prices crater and move on to very wide, in some cases, discounts. That will presumably be to do with investors liquidating their portfolios, some technical reasons like that. But whatever it was, it meant that there were incredible opportunities if you were able to steel yourselves and take advantage. Just as one example, we saw Greencoat UK Wind, not obviously affected by the pandemic, swing from a persistent premium onto a 15% discount and then back to a double-digit premium in just 2 or 3 weeks. So obviously, if you had managed to take advantage of these opportunities, you would have done very well. And I think the indiscriminateness, no matter how high quality the asset, how high quality the manager, whether it was even connected to current events, was quite something to see, and probably something to tuck away in your mind for the next crisis, where there may be similar opportunities.
Now, we're seeing some popular trusts trade at big premiums to net asset value now, as you say. So is it ever worth buying an investment trust on a premium? And if so, what level do you consider to be too high?
I wouldn't put a level on what's too high, but I do think you need to be aware that as the premium rises, the risks to the downside also rise. You can think of a premium as a form of downwards only gearing, really, where in an event where the NAV performs poorly, the underlying assets become out of favour, that any losses to NAV can be magnified by investors rushing for the exits, whereas there isn't really a corresponding upside benefit to that premium. There's no real sort of gearing to the upside, if you like. So it raises the risks that, in a way, that you need to be aware of. Perhaps the way to think of it is, as the premium rises, your conviction in the underlying assets need to rise. If we think of some of the technology or e-commerce related portfolios that have tended to trade on high premiums, the sort of growth being expected by the fund managers from these companies would make a 5 or 10% premium irrelevant over long-term holding period. So if your conviction is high enough in the underlying portfolio, there's not necessarily a problem with paying a premium. When it comes to the alternative assets, you also need to be aware of the fact that really the valuation of those assets is often not on a market basis. There's no daily pricing. So the valuation is based on the assumptions of the fund managers or independent professionals. But they are assumptions that are open to change, that can be challenged. There are levers that can be pulled one way or the other. So a premium needs to be sort of taken with a pinch of salt in these cases. And you can have some portfolios which trade on a persistent premium for a long period of time because the market thinks that the valuation assumptions are more conservative than peers, or more conservative than would be revealed if the assets were to be sold. So when it comes to premiums on alternative assets, then you need to use that as the starting point for an investigation of, okay, how are these assets being valued? What is the flexibility here? But in both cases, I think an investment trust on a premium warrants detailed investigation.
So it shouldn't necessarily be disregarded just because it's on a premium.
Absolutely not. No, I think as long as you're aware that the risks rise as the premium rises, if your conviction is high, then it's a very good investment.
Now, Thomas, it's been a terrible year for many income investors. Which strategy should they follow, do you think, to generate income in 2021? Do they need to be ultra careful next year?
Well, you say it's been a terrible year, but of course, investment trusts have generally speaking, equity investment trusts have been a bit more insulated than invested in open-ended funds, thanks to the building of revenue reserves over the longer run. So there haven't been so many dividend cuts in the equity income trusts. There are also trusts which pay an income out of capital. Clearly, that has not been disturbed by these events. So there have been some areas where investors have been relatively becalmed. And in fact, if you look at the UK equity income sector, even though the UK was very much out of favour, this could be seen with the all company sector and the small cap sector, the equity income sector remained on a relatively tight discount throughout the year because investors recognised the greater resilience in the revenue reserves. That said, there have been, and there may continue to be, this crisis is not over. Clearly, we don't know what will happen hopefully we can see an end in sight, but we don't know how long it will take to get there. And the impact on companies' income and the dividends that they're able to pay out next year is yet to be fully seen. So there's still the possibility of investment companies having to rebase dividends. And certainly we've seen a couple of investment trusts recently take a cut to their dividend because they want to secure a base from which they think they'll be able to grow. So that we could see that next year. I think for next year, I still think that alternative sources of income look relatively secure. So if we think about infrastructure and renewable infrastructure, these subsectors, they have a big political tailwind behind them. They pay considerable yields and they are not very affected by a recession, shall we say. So these are the sorts of areas that might be good to look at for a more dependable yield. Specifically, wind power, solar power. There are interesting yields on offer there.
Okay, so that's some of the sectors and themes perhaps that you like. I mean, are there any sort of trusts within that, any income choices for 2021 that you can share with us?
So I think within the renewables space, Greencoat UK Wind, the renewables infrastructure group, both display pretty good dividend cover throughout the year, which means that hopefully they should be more resilient. Clearly, it triggers a more diversified portfolio, which it has more than just wind assets, which maybe adds some resilience. But Greencoat UK Wind has had no difficulty even from wind power in maintaining a very good dividend cover even through 2020. Obviously, these trusts did see, they're not immune to the effect of a reduction in economic activity, as that can bring down power prices. But these two have been relatively resilient. Thinking about equity income trusts for 2021, I actually think that the UK could be relatively attractive. I know I probably said this last year, and obviously a lot has happened since then, but certainly the UK has been undervalued for a considerable period of time. And although we have the Brexit talks to get through, and perhaps January and February could be difficult, I think any kind of resolution to that issue could be good for the UK, and perhaps also for sterling. So maybe being invested in sterling could be a better place to be in the next year as it has been in the last few. One which stands out, and a trust which stands out, is City of London, which I think has done a remarkable job both before the crisis and during the crisis, and actually looks set to raise its dividend for 2021, having not had to cut it at all, which I think is a testament to good management, but also the job the board has done in building up reserves in the good times.